Gargi, how do you feel about the trading strategy right now, given what we know today?
Yeah, Sonali, the thing that we've been talking about pretty much from the start of the year is the fact that we do like fixed income here, but where you own duration is really important. So keeping that duration contained in sort of the belly of the curve, the front end to the belly, right around that 4-year point perhaps, and then recognizing that this is an environment not for owning duration, but for clipping coupon. So really allocating across IG, across EM, across high yield with active strategies that can clip coupon at these extremely attractive levels that, you can build a portfolio earning 6.5% yield, which normally you would look at a much riskier, much higher volatility portfolio, but you don't have to do that anymore. So fixed income makes a lot of sense, but stepping too much out in duration, I think you don't have to do that right now, given the shape of the yield curve and given the attractiveness of the front end.
Matt, what happens if the Fed does not get the opportunity to cut this year? What's the ripple effect?
So that's an interesting point. We've always said we believe we're at or near the end of the rate hike cycle. Even though we believe one cut's coming and more cuts are coming next year, we wouldn't take one hike off the table. But look what happened today. Strong jobs report. But did the 30-year sell off? Did the curve get steeper? No. The curve inverted slightly more, right? The 30-year was the least worst performing. So the Fed actually did have to hike. We're still not that concerned about longer duration. That would just be them getting ahead of inflation, trying to slow the economy. That really doesn't change our view on being so long duration because, again, you saw it today. Strong data was worse for the short end of the curve, not as bad for the long end of the curve. Again, look across the curve, 2 to 2.5% real across the curve. We're not that afraid of duration risk at this level right now.